Welcome everybody to the Apartment Owners Association. My name is Jeff Fowler. I'm Vice President here, and today we have a great information for you on tax preparation. You're not going to want to miss it for sure. And this is being sponsored by Robert Hall and Associates. They've been in business. This will be their 50th year. Can you believe it? They have 500 five-star Yelp and Google reviews, which is just incredible. This is a company that you really can trust. Just to say that, they are nationwide, and they're ready to help you with all your tax preparation needs. So shout out to them. And just want to mention AOA, introduce you to us if you're new. AOA is the largest individually organized group of apartment owners in the state of California. And what our goal is to help you make and or keep more money and to make the process of providing housing for others easier and more enjoyable. And we've been doing that for just about 40 years ourselves. And just wanted to highlight one thing that we do, and that's advising. So when you become a member, you not only get a magazine every month, you not only get the tenant screening, but you also get access to somebody that can help you. And lots of times you can read the laws and you just need to make sure, and you just need a little advice on how to manage that property. And so they're here, they're available for you to call in. We have all the way from Alameda all the way down to San Diego. We have local offices, and unfortunately everybody's closed right now, but when COVID is over, we'll be back open. But you can call. You still can call and get local advice on how to manage your property. And so I just wanted to introduce you to that one benefit that we have. And also, we actually need one advisor. And so if you are in the San Fernando Valley, we would love to. We have one for the main office that we need. You could contact me at jeff@aoausa.com, and I'd love to speak with you. And we are in the process of finding one incredible, enthusiastic, someone with property management experience, or someone, and so that's what we're looking for. We'd love to have that, love to meet you. And yes, so also just want to mention that you'll want to listen all the way through to the end today. At the end of the presentation, there's going to be a special offer for you, and you won't want to miss that. And so when it comes to subscribing, this happens all the time where our speakers, they offer something at the end of their presentation before we go into Q&A, and it's something that will benefit you greatly, and you don't even have to pay a dime for it. You just need to listen. And so anyway, I want to encourage you to listen all the way through and hold off on the questions until the very end, because I bet you our speaker will answer a lot of your questions before we even get there. And next week, we do this just about every week. Next Thursday, we have Zebra Construction, and they're going to tell us about retrofit. There's so many people that have lost tons of cash from people. It's so sad, but just tons of people that will lie to them and not do really what needs to be done, or one thing or the other, just drag it out. And so many unhappy people with those construction companies. So you'll want to hear them and know what to look for. So that'll be another way for you to save money. And anyway, we want to keep you in the know on everything. And so here we are. So we get to keep you on the know today about your 2020 taxes and the biggest things that the biggest tax deductions. And there's a whole lot of other stuff, 1031 and other things that he's going to talk about today. Our speaker today, he's been in the business for 17, this is his 17th tax season. And he is a senior tax consultant. And he received the Glendale Reader's Choice Award for Best Tax Preparer in 2016. He's a speaker as well, and he just has a wealth of knowledge that he's going to share with you right now. It's my pleasure to introduce to you Tony Watson.
Excellent. Thank you so much, everyone. Thank you, Jeff, for that wonderful introduction. My name's Tony Watson. Welcome, everyone. I'm so privileged and honored to be here today. I've been speaking on behalf of Robert Hall & Associates for quite some time now, and it's always a very special time for me to come and share this information with everyone who is an AOA member. So welcome to those of you who are veteran AOA members. To those of you who are new, welcome. We're going to be covering a lot of information today, so we'll go ahead and jump right into it. Let's go ahead and... All right, so today we're going to talk about quite a bit, not just one basic topic. We're going to cover quite a few things that are near and dear to my heart as not only a real estate investor, a small business owner, and a tax professional. But when we talk about real estate and Uncle Sam and the tax liabilities, we really want to hone in and focus on ways to better shelter our money, right? About 2 or 3 days into my life at Robert Hall & Associates, Bob Hall Sr. told me, Tony, it's not about how much you make. It's about how much you get to keep. And so through proper tax planning, and everybody has the right to do proper tax planning, we can eventually get to a place where we pay our obligation in tax and not a penny more than that obligated amount. So that's the goal, always and forever, when you talk about tax planning, when you sit down with your licensed tax advisor. And it's very important for you all to work with licensed tax advisors, people who understand the industry and the tax code that surrounds your industry and angles and ways to max out those benefits. So sell high, tax low, what every tax-savvy investor should know, presented by myself, Tony Watson. And once again, I'm very honored and privileged to be able to bring this information to you on behalf of Robert Hall & Associates. So like Jeff had mentioned, I've been in the industry for quite some time, over 16 plus years in overall tax preparation and representation. I am not only a tax preparer, I'm also a public speaker. I'm a real estate investor, a small business owner. My wife owns a small business, so I absolutely practice what I preach. And I have clients who manage and own over $150 million in real estate. That's just me individually. Our firm overall, I can only imagine that we must be in the billion-dollar range now. But I myself, with my own individual clients, roughly about 150 plus million in managed real estate. I'm also the keynote speaker. 2020 was a very interesting year. 2021, very excited to enter into 2021 and start it off with a bang. 2020, we covered roughly about 140 plus webinars. So we were bringing information to all of our clients, new, current, and old clients as often and as possible as we could via Zoom, via FaceTime, Skype, however we were able to connect with them. Thank goodness for technology, which brings us into your homes and cars maybe today. So without further ado, let's go ahead and jump right into the main information. Oh, before I forget, actually, I did want to mention, I'm going to mention this at the end as well. We do offer free consultations. Just before I forget about that, I am going to mention it again at the end, and you will have a chance to go ahead and send in your information to sign up for that free consultation. All right, first and foremost, let's go ahead and talk about, well, if the clicker is going to work here, let's go ahead and use, for some reason, there we go. All right. So let's talk about some of the top tax deductions for real estate investors, real estate professionals, where they can really maximize the overall tax sheltering through these specific deductions. Some of you might be sitting at your computer screen or in front of your cell phone screen saying, these are deductions I absolutely take. Well, do you know why you take them? That's probably the biggest question. Do you know why you take these deductions, how you are taking these deductions, what percent are you taking, what kind of tax benefit are you receiving by maximizing these deductions? Well, I wanted to show you what's kind of old and what's new and talk about some of the hypothetical changes that could be coming up in 2021. We're not going to spend too much time on the hypotheticals today. But when talking about 2020 and 2021, which as of now, most of the tax code will stand very similar as of 2021. I think that it'll take probably another year, maybe a year and a half before any major changes are implemented to the Internal Revenue Code. But when we talk about some of these top tax deductions for 2020, we're really looking to hone in on as many dollar-for-dollar write-offs as possible. Now, when I say dollar for dollar, I mean that if you make $10,000, you'll want to look for as many dollar-for-dollar write-offs to offset that $10,000 as possible. Obviously, when you are able to offset all of your income, you might run into issues with financing down the road because you show no income. But at the end of the day, when you're looking to shelter money from income tax, you are truly looking to offset your income dollar for dollar. You collect $10,000 in rent, you have $10,000 in expenses, you show zero income, you pay no income tax on your cash flow. That's the name of the game. So when you are entering into real estate for the first time, if you are a veteran real estate investor owning 15, 20, 30, 40, 50 plus properties, however much you invest in, you're going to want to maximize these specific deductions more than ever, especially if you are planning on retaining more of your earned income and rental income that you've earned throughout the last calendar year. So number one, marketing and advertising expenses and promotional expenses. Dollar for dollar tax deductible. Let's face it, when you have a vacancy, how do you get another person in your property? You have to promote, you have to advertise, you have to put out into the ether information about the address that you own and how you need somebody paying you to live there. And so marketing and advertising and promotional expenses are dollar for dollar tax deductible, offsetting your rental income dollar for dollar. On the self-employed side, if you are a property manager, you have self-employed income, marketing and advertising and promoting expenses are going to be dollar for dollar tax deductible as well. Robert Hall & Associates, for instance, we reach out to our clients in more than just one way. Obviously, we do webinars, we do mailers, we do newsletters, we do email blasts. We do a number of things to get our name, to get our information out to the general public. And every dollar that we sink into those marketing and advertising expenses, that's going to be a dollar for dollar write-off for Robert Hall & Associates and any other businesses that the Halls invest in. So just understand that we are looking for dollar for dollar adjustments to income, and marketing and advertising is absolutely a great dollar for dollar write-off. Number two, professional supplies and equipment. Whether you like it or not, the federal government knows certain things about your deductions and how you should or shouldn't be writing them off. I like professional supplies and equipment for a number of reasons. One, it has the lowest risk for audit, because let's face it, how many people do you know in today's day and age who can do what they do in business without a cell phone, without a laptop, without a printer, without a fax machine, right? These are some of the most common business deductions that we can think of, and the government expects you to have these specific deductions. On top of that, what about furniture, desks, chairs, filing cabinets, shelving units, storage units? Especially and specifically for 2020, when most people were moved out of their brick and mortar to work more from home. Now, the government, we're going to talk about the in-home office in a couple slides here, but I want to make sure that people understand how they are able to deduct office furniture and supplies and equipment. Another reason why I really love this deduction, aside from having a low risk for audit, is the fact that we have options of how to write these expenses off. The federal government gives equipment, for instance, a 7-year lifespan. So if you go out and you buy that brand new laptop, your other laptop died, and you're looking to buy a brand new PC or MacBook Pro, whatever you're buying, the government will either allow you to accelerate that write-off to take it all in 1 year if you have enough revenue to offset with that expense, or you can depreciate the expense over the lifespan of the asset. For a computer, for instance, a piece of equipment has a 7-year lifespan. So you have the option of either taking it all in 1 year as a write-off or taking it over a 7-year period. Options. In the tax industry, when it comes to write-offs, we love having options of how to deduct things. Same with furniture, except furniture has a 5-year lifespan, not a 7-year lifespan. But when you accelerate the write-off to take it all in 1 year, it's not something that is just assumed by the software program you are using. This is an election made by your tax advisor. It's called the Section 179 election, and that allows you to accelerate the write-off to take it all in 1 year. At the beginning of this last year, I'm used to working in an office setting, and the halls provide all of our computer equipment. We have beautiful desks, we have beautiful office space. But when we were not forced, but everybody was suggested to move to home, to work out of the home, to slow the curve or to bend the curve. I forget what the term was. And so a lot of us started working from home for the first couple months, if not half a year to 8 months out of 2020. So when I moved home, I had to upgrade my equipment. And naturally, as an employee of Robert Hall & Associates, I'm not allowed to deduct those expenses against my W-2 income. But for my other businesses that I own, my wife's business, my small business, my real estate portfolio, I needed this type of equipment in order to do what I do best and be more efficient in my processes. And so when I went out and bought that computer, I was able to accelerate that write-off, or I will be able to accelerate that write-off in the upcoming year as a dollar-for-dollar tax deduction. So once again, professional supplies and equipment, always a great write-off, and you have options of how to deduct this specific expense. Car and truck expenses, very unique deduction. In fact, this specific slide actually generates more questions than I'd ever thought a particular topic would generate. Everybody here in Los Angeles and across the U.S. very interested in how to properly deduct their auto and truck expenses. Am I going to take mileage? Am I going to take actual car expense? Am I going to take depreciation? Am I going to take the lease expense? Which one is right for me? Am I limited on certain amounts of these deductions? Well, I'm going to talk about mileage and actual car expenses first. And then there is a slide that's coming up that will talk about leasing versus purchasing. And we're not going to spend too much time on this topic today, but I will whet the palate for you to essentially start a conversation with your tax advisor about which is right for you. Because what is right for your neighbor, for instance, might not necessarily be right for you. Okay, just because your neighbor went out and bought that 6,000-pound Chevy Tahoe and fully deducted it under the new tax code doesn't necessarily mean that you're going to get the same benefit. You need to have this consultation, this conversation with your licensed tax advisor as to which is best for you overall. So the government doesn't actually allow you to take mileage and actual car expenses. They're going to ask you to take one or the other. And generally, it's whichever one's going to save you more tax. I can tell you 9 out of 10 times people will opt for the mileage write-off because mileage is a pretty sizable deduction, number one, at 55 cents per business mile, and it also has a very low risk for audit. In fact, in the 16, 17 years that I've worked for Robert Hall & Associates, I may have had one situation where an agent asked for a mileage log, and at that point, if you have a mileage log, that's what you represent the deduction in an audit with. It's essentially proven with your own notes. And so I like mileage for a number of reasons. One, low risk for audit. Number two, it's proven in that audit with your own notes, and it tends to be a very sizable write-off. Let me give you an example. Let's say that you own and manage several properties and you're putting a lot of business miles on your vehicle. Let's say that business mile total 10,000 miles. Well, at 10,000 miles, you get a $5,500 mileage deduction write-off because it's at 55 cents per business mile. Well, I mean, in order for actual car expenses to be greater than $5,500, you'd be looking at maybe an engine rebuild, multiple tire changes, repairs and maintenance, things that weren't covered under warranty. And 9 out of 10 times, the mileage deduction is going to be much larger of a write-off than the actual car expenses. So don't force things on your return. Have these conversations with your tax advisor to make sure that you're deducting whatever is saving you more in tax. Remember, it's not about how much you make, it's about how much you get to keep. And every taxpayer has the right to plan ahead to pay less tax, and we will hit that obligation in tax through proper planning. Failing to plan is ultimately planning to fail. So before you jump into preparation, sit down and figure out a plan with your tax advisor to retain more of your wealth and not to pay most of that wealth to Uncle Sam and the state, whichever state you file taxes in. So that's number 3. Number 4, legal and professional fees. In 2018, we heard a very interesting change to the Internal Revenue Code that dropped legal and professional fees off of the return as a write-off. Well, that is only specifically related to W-2 wage earners. As of 2018, if you are a full-blown employee and you don't have rental income and you don't have self-employed income, yes, some of these write-offs see some pretty significant limitations. In fact, legal and professional fees for W-2 wage earners on the federal tax return, no longer a tax write-off. See, legal and professional fees, cell phone expenses, computer expenses, office furniture, mileage. For an employee under the Internal Revenue Code, those are called 2106 unreimbursed business expenses. They actually get filed on a form called a 2106. As of 2018, the federal government has removed that 2106 form so that employees can no longer deduct these specific expenses. However, they did not remove these deductions for self-employed individuals and rental property investors. So on your Schedule E's and your Schedule C's, you will still see a line item for legal and professional services. They are still going to create dollar-for-dollar tax shelters for you on your individual return. So make sure that you understand that you are still allowed this deduction, but on very specific forms. Number 5, last but not least, property deductions. Now, I'm going to dive into a little bit of detail of what property deductions are, because we're not just talking about mortgage interest and property taxes, are we? When you rent out a property, when you own a property and you rent it out, you have a tenant living there, it's more than just the mortgage interest and the property taxes you're able to deduct. Naturally, if you're a veteran real estate investor, you know this already. But for those of you who are brand new to real estate, understand that mortgage interest and property taxes, those are great tax write-offs and the only tax write-offs for a primary residence and a second home. Now, a primary residence is the home that you live in. A second home, by definition under Internal Revenue Code, a second home is just a second residence that you use for personal use, not a rental property. So when you take one of those homes and you rent it out, yes, you are converting the second home or the primary residence into a rental investment. And at that point, once you rent out a property, you essentially open the floodgates for additional write-offs above and beyond mortgage interest and property taxes. See, when you turn a property into a business, when you start to rent it out, you now get to play the benefit of a business under the Internal Revenue Code. You get to play all of the benefits or play by the rules of a business, which if a business generates revenue and has expenses, most of those expenses are going to be dollar for dollar adjustments to that income. You collect $10,000, $20,000 in rental income, and the property has mortgage interest, property taxes, insurance, improvements, repairs, maintenance, anything totaling up to $10,000, $20,000. You are allowed that as a dollar for dollar adjustment to your income. So property deductions vary based on what the property is used for. Is it a primary residence or a second home versus a rental property? Now, a primary residence, yes, there are limits to what you can deduct in property taxes and mortgage interest. As of 2018, if you've purchased a home to live in after December 15th of 2017, you are limited to what you can write off in mortgage interest. You are only allowed the interest on the first up to the first $750,000 of debt. That's on a primary residence, and actually that's $750,000 for a second home as well. But only for home purchases, make sure that you understand this, only on home purchases that were made after December 15th of 2017. See, if you bought a home to live in or a second residence prior to December 15th of 2017, you get to play by the old rules, meaning that you are allowed the mortgage interest on the first $1 million of acquisition debt. So there are a couple changes that you need to be aware of mortgage interest-wise, depending on when you purchased the home, either before December 15th of 17 or after December 15th of 2017. That's for mortgage interest. That mortgage interest topic has nothing to do with something called the SALT cap, which includes a $10,000 cap or limit on specific deductions. So mortgage interest has its own limit, and the SALT deduction pertains to property taxes on your primary residence, property taxes on your second home, and state income tax that you pay in whichever state you file state income tax in. So understand that before 2018, when you added up your primary, your second home, and your state income tax, let's say that totaled $30,000. In 2017 and before, you would actually put that $30,000 number on a form called a Schedule A. And in your mind, you thought, oh, well, I'm paying all of this tax, but hey, let's find the silver lining in all of this. At least I get it as a write-off. Well, understand that prior to 2018, even though you saw that $30,000 deduction on your return, whether or not you were allowed it fully as a write-off is a different story. See, hidden in the old tax code was something called alternative minimum tax, AMT. I'm sure that some of you understand what AMT is. You probably have been subject to it in the past. Some of you might not know what AMT is. AMT is not a special strain of COVID-19, okay? AMT is not a machine that you go and take money out of. AMT stands for alternative minimum tax. And AMT was a built-in limit to your SALT deduction prior to the new tax bill. And a lot of clients didn't know this because AMT was truly hidden in the Internal Revenue Code. Now, AMT was a much larger limit than what is currently in place. In fact, prior to 2018, if your income breached $200,000 or $300,000 of household income, you may have been subject to AMT, but not fully. As soon as you breached $400,000, $500,000 in income, AMT most likely fully set in on your return. And if you were fully subject to alternative minimum tax, this nasty AMT, actually, it's kind of like a disease at that point. If you were fully subject to AMT at that point, you weren't allowed any of your state and local tax deduction. AMT worked like a sponge, and it sucked up and soaked up all of your state and local tax deductions. Now, fast forward to 2018 with the property tax side of things, the federal government said, hey, we're going to adjust AMT. We're going to make it so that less people are subject to AMT, but in place of that AMT limit, we are going to cap your state and local tax deduction, also known as the SALT deduction, at $10,000 total. Now, remember, this is only on the federal side. This is not on the state side. So the state of California still allows for some pretty nice write-offs for property taxes. But the federal government, which is the code that we're talking about today, the IRC, the Internal Revenue Code, they put in a $10,000 total cap on state and local tax deductions. So some of you are probably throwing something at the screen right now saying, I didn't understand this. I didn't know about this. Well, that's probably the fault of your tax advisor. This is something that's been around for almost 2 years now, and as we enter into 2021, there will be some adjustments. The federal government is talking about removing that $10,000 limitation. Nothing has been set in stone yet. But with that $10,000 limitation, some of you may have been impacted negatively. Some of you might not have seen much of a change. Some of you might have actually gained a benefit because of that $10,000 cap. I know it's hard to believe. But if some individuals were subject to that alternative minimum tax prior to 2018, and now they are not, Some individuals could actually be gaining a $10,000 write-off under the new tax code. The reason why I'm going into so much detail about this is to show you how complicated the Internal Revenue Code is, why it is so important for you to utilize your tax advisor as much as possible to receive advice, information, updated information, old information, and also to have them do full-blown reviews of your tax return and explain to you what these major changes meant for you in numbers. To look at your tax return and say, hey, prior to the new tax bill, this is how you were impacted. Because of the new tax bill, you gained a refund, you lost a refund, you broke even, didn't really have much of an impact, but you need to understand how things impact you individually. I'll tell you right now, being real transparent, that is really the true way that you are going to be able to grow wealth, is by knowing enough to minimize liability with Uncle Sam and retain wealth through proper tax planning. So always keep that in mind. Now, when you convert a property into a rental investment, remember, you're talking about mortgage interest, property taxes, insurance, improvements, legal and professional fees, travel back and forth from some of your properties, any supplies that you purchase, miscellaneous overhead expenses. It opens up the floodgates for additional tax-sheltered deductions. Some of you may be allowed all of the deductions to offset rental income. Some of you may be limited on certain deductions based on your overall income. So everyone will receive a different benefit from real estate investing. Before you jump into probably what will be the largest investment you will make in your lifetime, before you jump into that investment, sit down with a licensed tax advisor and map out a strategy. Put a plan in place because, like I said earlier, if you fail to plan, you will ultimately be planning to fail. There are ways to structure your investments to maximize these benefits, making sure that your AGI is below a certain threshold to where from every angle, left, right, up, down, front, and center, you are maximizing the real estate deduction potentials that you so rightfully deserve, but only per the advice of your licensed tax advisor. Keep that in mind. Now, jumping back to the auto and truck really quickly, and then we'll move on to the more important topics here. A lot of clients have been calling in about leasing versus purchasing. I just wanted to verify with you first and foremost, or clarify with you first and foremost, that there is a significant difference between the deduction of leasing a vehicle versus purchasing a vehicle. And this actually started in 2018. So for those of you who are property managers, for those of you who have self-employed income sources, or those of you who manage many real estate investments, not so much as property management, managing other properties, but managing your own properties, you potentially could qualify for a pretty sizable car deduction depending on if you're leasing versus purchasing. Now remember, the federal government is going to expect you to take, if you own one vehicle, and allocate that one vehicle between personal and business use. If you own two vehicles, one for personal use, one for business use, the business vehicle, more likely than not, will qualify for a greater tax deduction. Leasing, in most cases, if this is your scenario where you have one vehicle specifically used for business, leasing on that vehicle is potentially a 100% tax deductible expense for you. But leasing is a very low, more consistent write-off, isn't it? Purchasing a vehicle could give you a much larger upfront deduction in the very first year of purchase. In fact, in 2018, the federal government reiterated and also brought back something into the Internal Revenue Code called bonus depreciation. Now, bonus depreciation, it only qualifies for you. It only qualifies for certain vehicles based on weight class. If the vehicle weighs under 6,000 pounds, you get an upfront accelerated depreciation write-off of $18,000 in the first year, and then the remaining value of the vehicle, if it's under 6,000 pounds, is depreciated over the lifespan of the asset, which can be up to 5 years. If the vehicle weighs over 6,000 pounds, it qualifies for another type of bonus depreciation called 100% bonus depreciation, meaning that if you bought a vehicle for business use and that vehicle weighed over 6,000 pounds, it could potentially be a 100% tax deduction for you. $60,000 Chevy Tahoe weighs well over 6,000 pounds, could potentially mean a $60,000 write-off for your business. Now, I'm not saying all of you will qualify for this, am I? I'm saying that some of you may qualify for this benefit, but you need to make this decision based on advice coming from your licensed tax advisor. Always make sure that you run these scenarios by your licensed tax advisor before making these very these significant choices to purchase large assets, whether it be a car or a piece of property. Have your accountant involved in that conversation at every corner, okay? Now, jumping into asset protection for a quick minute here, what entity is right for you? Should you be acquiring your property under an LLC? Should you be acquiring your property under an S Corp? Should you be putting your properties in C corporations? Well, I mean, yes and no. It really all depends. And I absolutely despise using the word depends, but in my industry, it actually does really depend on your specific scenario. See, if you acquire a property under a corporation, most people don't think that, oh, well, there is no tax liability until I sell the property. Well, if you use an S corporation or a C corporation to purchase or hold title to property under, you have to be aware that you are exchanging that property for shares of a corporation. See, when you start an S corporation, you own that corporation by the amount of shares issued to you as the primary shareholder. And before it gets too complicated, I promise you that I'm going to come full circle with this and it'll make complete sense at the end of this next 2-minute explanation. When I start a corporation, the corporation issues shares to the shareholder. Let's call it 5,000 shares, right? I start my S corporation, I issue myself 5,000 shares. I go out and I buy this property, or let's say I've already bought the property and I transfer the property into the S corporation, and let's say the property is worth $300,000. At that point, $300,000 is exchanged for $300,000 in valued shares. So my 5,000 shares are now worth $300,000 because that's the asset that I put into the corporation. Now, hypothetically speaking, let's say that over the next 10 years, that $300,000 property is now worth $1 million. Very, very possible for that to happen, especially in some parts of California, in fact, actually most parts of California. Let's say it goes from $300,000 to $1 million over a 10, 15, 20-year period. And at the end of this period, I decide that, hey, I want to use this corporation for something different. I don't want to use it for real estate anymore. I would like to take the property out of the corporation back to my personal name, which in our minds is not selling the property, correct? But when you take that property out of your corporation, you are distributing, or you're distributing property, but in the eyes of the IRS, you are actually selling shares of a corporation. See, even though you didn't sell the property, when you take that $300,000 property now worth $1 million and you bring it back to your personal name, the federal government sees it as you making a $700,000 capital gain on the sales of shares of your corporation. So understand that even though you didn't sell the property, you may end up having to pay the piper on $700,000 of capital gain. Doesn't seem fair. That's just the way that the rules are. And that's why corporations like S corporations and C corporations, like I showed you on the slide, S corporations, C corporations are not technically the right entities to use in acquiring title to rental investments. The most common entity used to acquire title is the limited liability company. Now, one thing that you want to make sure that you understand about the differences between LLCs and corporations is that an LLC is a company. It is not a corporation. So when you incorporate an LLC, you actually file articles of organization, not articles of incorporation. And so when you own an LLC, you don't own it by the amount of shares issued, you own it by percent. So if I'm the only owner of an LLC, I own 100% of the LLC. If I own 100% of the corporation, I own 100% of the shares of a corporation. So make sure that you understand the differences. And if this is something that wow, my head is spinning around, my eyes are rolling back, I've already fallen asleep, well, understand that these are not things that you individually need to research. These are things that your legal advisors and your tax advisors will explain to you if you want to learn more about it, which I suggest you do. Everybody wants to learn more about business, especially if you're really, really serious about building wealth and retaining wealth. But make sure that you're utilizing the correct entities, because now more than ever, it's very easy for us to go on LegalZoom, on certain websites, and start our own entities, and we could be starting the wrong type of entity per the advice of a non-licensed tax advisor or a neighbor or a coworker or a family member. Remember, just because an entity worked for a neighbor or a friend does not necessarily mean it will be the same for you. So you need to have this conversation and receive this advice from a licensed tax advisor, somebody who understands the differences, the tax implications, differences between these types of entities. LLCs will be the most common entity structure for acquiring title, and LLCs can distribute property, they can acquire property, they can change ownership of the property, allocate different percentages in ownership without having a significant tax implication on the back end. Unlike a corporation that may actually end up generating a sizable overall capital gain, even if you didn't sell the property. So just be aware of that. The number one benefit of incorporating, however, is not tax savings. The number one benefit of incorporating is asset protection. That's the first thing right out the gate that you receive. And so a lot of clients say, well, Tony, if I have this great insurance policy, why would I need an entity? If I have an entity, why would I need a trust? If I have a trust, why would I need an entity or an insurance policy? Well, understand that an insurance policy, an incorporated entity, and a trust, they all provide separate benefits for you as a business owner, as a real estate investor. An insurance policy is by far the most important thing for you to have. We have insurance in place to pay out settlements in case an unforeseen event happens. That's why we have insurance. We have an entity to separate our business and our personal assets. So the more we separate our assets, technically, the better protection we have. On top of all of that, when we pass away, yes, unfortunately, in order for a trust to really kick in as a major benefit in most cases, someone has to die. It's a very dark subject. It's not my favorite part of what I do in the tax world, but we deal with this a lot in the tax world. We deal with death and despair, unfortunately. But the last thing that you want to happen in death is for your assets to be seized by the state in which you own the properties and held in probate court and forcing your next of kin, your heirs, to lawyer up and fight the state in probate court for all of the assets that you've worked so hard to obtain over your lifetime. So these are all proper ways to set yourself up for success, to protect your assets, to insure your assets, and to make sure that the transition after death to your next of kin is smooth. It's efficient. And I know that there's going to be a lot of questions about Prop 19. I'll answer very general questions about Prop 19. I would absolutely suggest those of you who have questions about Prop 19 to reach out to our office for a one-on-one consultation. Everyone's scenario is different. So the answers that in the Q&A session later for Prop 19 questions, unfortunately, I'm going to have to be very general about some of those answers, just because I need all of the pieces to the puzzle. I need to make sure that I have all of the information to where I'm advising you correctly. I do not want to give one person information that might not actually correlate to anything else that somebody else is trying to achieve or accomplish. So just be aware of that. Everyone's tax return is unique. Everyone's tax return is different. Always keep that in mind. But understand that when you start to transfer title in and out of entities, whether it be LLCs, S Corps, C Corps, when you pass on assets after death to next of kin, there are additional benefits on top of the property tax benefit that was in place prior to Prop 19, which doesn't really kick in until this end of this February 21st, I think it is. So you have to understand that if you start to move assets prior to Prop 19 really kicking in, you could potentially be giving up some serious and significant tax benefits, income tax benefits on the back end. See, property taxes and income tax, two completely different worlds. So when you start to make rash decisions based on a property tax change like Prop 19 and that being implemented, if you start to make major and rash decisions, you could be avoiding major tax benefits on the back end when it comes to income tax filing. So have these conversations with a tax advisor. Do not do anything on your own without having a licensed advisor, a professional advisor, mapping the road out for you. It's a very rough ocean out there if you try to navigate the waters yourself. Help us navigate those rough waters and steer you in the right direction, okay? Now let's talk about whether or not buying in-state versus out-of-state is a benefit. I call it the mass exodus, going on 17 tax seasons here. In the past 2 years, I have seen more of my clients leave the state of California than ever before. Just in 2 years, totaling over the 17 years, in the past 2 years, just alone in 2 years, I've seen more people leave California than in 17 years I've worked in the tax industry. I call it the mass exodus. And make no mistake, it's not because of any specific reason. They're for a number of reasons. And this has been happening for quite some time because let's face it, California, as unique as we are, as beautiful as a state that we live in, it is the highest taxed state in the U.S. New York and California flip-flop for number one. We were like competing with each other, this is not a good competition for anybody, but we were competing with each other for the highest tax rate in the U.S. California has now the highest tax rate amongst the 50 states. So for individuals who are, once again, serious about building wealth and retaining wealth, at some point, if you've built enough wealth, it actually would make sense for you to live somewhere else. Even if you have assets in the state of California that you manage, that you cash flow with, it may actually still make sense for you to live somewhere else. Now, just because you've moved to Nevada does not mean that you do not pay tax in California on your California businesses. So if you own 3 or 4 rental investments here in California, you jump ship and you move to the state of Nevada. Nevada is a beautiful place. Texas is a beautiful place. Florida is a beautiful place. There are beautiful tax-free states for you to move to. But if you have assets that generate revenue, businesses and rental investments in the state of California, California is a very unique state. They are one of about 7 or 8 states that taxes their residents on their worldwide income. Okay, so well, Tony, I'm not a resident anymore. I've moved. Well, California says that even if you've moved, you still have to pay a non-resident tax on the revenue that you generate in the state of California. Truly, the only way to avoid California income tax is to physically move and also move all of your assets outside of California. But wait, let's pump the brakes for a second. We're going to talk about something very, very interesting in the next slide regarding the 1031 exchange that some of you may not have been aware of. So if California taxes you, even if you don't live in California, on revenue that's generated in California, what is the difference in tax rate? Well, if you live in the state of California, you pay the full resident state income tax of up to roughly 12%. I'm not going to lie. If you're in the 12% California bracket, that means you're in the 37% federal bracket, which 37% plus 12% is what? We're looking at 49% plus 3.8% net investment tax. That's part of the 2012 Obamacare bill. Plus, your 15.3% in Social Security and Medicare, which half of it is a tax deduction. That's not including your property taxes, your state income tax, your state income tax is included, your property tax, your use tax, your sales tax. In some instances, a 1%er can pay well above 55 plus cents on the dollar in overall tax. In different types of tax, but that's a lot of money, correct? Well, when you're making $100 million, 55% is a lot easier to stomach than if you're making $1 million, correct? So eventually, once you reach that 1% bracket of 37% federal, 12, 13% state, your problems are different at that level of income. And I've told my clients since day one of working in the tax industry, I cannot wait until I cut those checks at the 37% bracket, because at that point I know I've made it. Sure, it's going to be hard to stomach those checks, but we all want to build wealth and retain wealth, whether it be for legacy or to leave our children with more of an estate value, whether it to be more philanthropic in our lives. It doesn't matter what you want to do with your money or why you want to build wealth. At the end of the day, that's your hard-earned money. And you need to figure out every possible way to shelter as much of it as possible within reason, within the 4 hypothetical walls of the Internal Revenue Code. But there are effective ways to do that, especially in higher income brackets. And this is something that we hone in on with all of our clients, especially as they start to retain wealth and build wealth in real estate. So in-state versus out-of-state, you have to be aware that California will sometimes follow you across state borders. Now, when we talk about the 1031 exchange, which is something near and dear to my heart, we also have to realize that the 1031 exchange is on a docket to expire. The Biden administration has been talking about getting rid of the 1031 tax-deferred exchange, and could it happen? Well, I'm not going to say yes or no, because these are all hypotheticals at the moment. It is a very dangerous time that we're living in from a real estate perspective, because when you get rid of a 1031 exchange type benefit under the Internal Revenue Code, you are getting rid of a part of the code that generates billions of dollars in revenue for the U.S. economy and creates thousands and thousands of jobs for the United States economy. So getting rid of something like that would be, I'm going to call it something, I think it's silly. I want to use a different word, but I'm not going to use that on today's webinar. I think it's silly because it's very short-sighted in the long term. Real estate is the true stimulator of the U.S. economy. Think about this. When a property is purchased, sold, exchanged, acquired, inherited, it creates a number of jobs for the United States economy. And that is what keeps us moving forward as an economy, more and more jobs. More jobs means more revenue for the government. More revenue for the government means better infrastructure for the United States economy. And it's this cycle that we go through, right? And we can argue about what that money's spent on till the sun comes up, but at the end of the day, that's simple economics. More jobs creates more revenue, better lives for people, more house purchases when houses are purchased or exchanged, more jobs with contractors, inspectors, mold inspectors, you name it, it creates 50, 60, 70 jobs on the back end, on the front end of any real estate transaction. Real estate is the true stimulator of the U.S. economy. Let me go back really quick. I don't know why it went to the next slide here. So the 1031 exchange, why does it exist? It is really meant to defer tax on income, right? It's meant to defer tax on exchanging or the sale of a property. Now, some of the tax benefits: avoid depreciation recapture on the property, limit capital gain tax, access money on a down leg exchange. And yes, you will pay tax in that situation, but if you go from $1 million property into a $500,000 property, accessing some of the cash, you could take the remaining gain and cycle it into another property. It's called a down leg exchange. You can acquire more doors, go from one property in Burbank worth $2 million into 15 doors elsewhere in the U.S. More cash flow. More doors equals more cash flow. And you can also reset depreciation on an up-leg exchange, going from a $500,000 property to a $1 million property. You can actually create more deductions for yourself in an up-leg exchange. I can't express to you enough how beneficial exchanges are for the United States economy, how beneficial they are from a tax perspective and allowing the taxpayer to retain wealth so that you can build your portfolio and create more jobs for the United States economy, and also create more cash flow for the U.S. economy, because the more money you make, the more tax you pay. But once you get into these 32, 35, 37% brackets, make no mistake, the games change. And it is much easier. Always remember this. It is much easier for higher income brackets to take advantage of tax shelters than lower income brackets. Always remember that. We know of the phrase, it takes money to make money. Well, that phrase kind of goes hand in hand with the tax industry. The more money you make, the more options you have, the more tax shelters will become available for you as you continue to make more wealth. So just be aware of that. Now, as a real estate professional, does the game change? Because I have a number of real estate professionals as clients. In fact, just yesterday, I was talking to a client about taking a $6 million property and exercising an exchange out of the Hollywood area here in Southern California. And when we mapped out this exchange paperwork, this client called in, not a current client, a new client, and the new client had expressed their concern with the kind of tax implication they would have if they sold the property outright. And that was the conversation at first. When they called in, they said, "Hey, Tony, we're thinking about selling this property. We want to know how much tax we're going to have to pay on it." So after dialing into the calculations, the capital gain was going to be substantial. I think they built the property at $800,000 30 some odd years ago. Now it's worth about $6 million. As you can see, that's a pretty sizable capital gain. Very low depreciation, but over that course of time, long-term capital gain on that much of an appreciated value is going to be a large payment to Uncle Sam. And so I said, well, let's pump the brakes really quick. Let's talk about a 1031 exchange first, both an up leg and a down leg. And after that consultation, the client actually went back on what they wanted to originally do. They said, we are not going to sell the property now. If you tell us that we're going to owe close to $1.5 million in taxes, I think it was a little bit more actually, in overall income tax because of the sale of this property, we don't want to lose that kind of wealth. So what did they end up doing? They ended up exercising, or they will end up exercising their right to take the $6 million property and exchange it for other investments elsewhere in the U.S. Now, they are also going to access cash out of the exchange, so there will be a tax implication, but nowhere near the $1.5+ million tax liability that they were originally going to pay. And I truly think that client will forever be a client of ours at Robert Hall & Associates, because we saved that client potentially $1.5 million. And to make things even worse, make the matter even worse, they were self-prepared taxpayers. The husband had been preparing the tax returns for a very long time. So thank goodness they reached out to a licensed tax advisor to save them over $1 million in tax. And I can go on and on about those specific, scenarios, working in the tax industry 17 years. You name it, I've probably seen it. You name it, Robert Hall has definitely seen it. So we are very much a firm that researches case study. We look at the different types of scenarios that have worked for our past and current clients, and we really try to maximize every angle of the Internal Revenue Code that we can possibly maximize. One angle that we really like to take advantage of, especially and specifically for individuals who spend most of their time working in the real estate industry, is the real estate professional election. Now understand that when you make this election on a return, yes, it does increase your risk for audit. Okay, it increases, just by checking this box, it could increase your risk for audit by upwards of 75% each year. Because what you're telling the government is that you specifically, and especially, because you're all special, I promise you, you're all special, that you are especially special, a special person to make this election as a active real estate professional, somebody who actively manages actively participates, actively works within the real estate community, generating more than 51% of their income from real estate related activities and spending more than 51% of their working hours working with real estate related activities. Okay, it's called the 51 rule. On top of that, the federal government requires a 750-hour requirement. And if you meet both of these requirements and we are able to check that box, it opens up the floodgates for additional tax sheltered deductions. Based on AGI, I'll give you one specific example before I wrap up and we get to Q&A. One specific example, I had a real estate professional come into my office 5 years ago, new client from a Keller Williams office somewhere here in LA. And the client had come in with real estate investments elsewhere in the US, had some properties here in California, but a majority of their income was commission-based income from real estate sales. And I noticed a couple things on their return. One, there was no depreciation on the properties. I don't know how that happened. Two, their deductions just weren't in line with the type of revenue that they were making. They had never been discussed with on a SEP IRA contribution or incorporating. There was a lot that went wrong on that return. And so when we took them in as a client, we incorporated their business. We started depreciation on the properties because when a depreciation is allowable, it must be taken. That's verbatim out of the Internal Revenue Code. You do not have an option of not depreciating property. When it is allowable, it must be taken. So we corrected all of these issues, and on top of that, we are able to make the real estate professional election. Now, in this scenario, just through incorporating, just through issuing payroll to them, maximizing deferred comp, starting depreciation, and making this election as a real estate professional, allowing this real estate professional to fully deduct the losses through their real estate portfolio, instead of owing what was projected to be roughly $175,000 of tax in that first year, we were able to get that client down to under $40,000 of tax just by planning. Now, I'm not talking about meeting with this client during tax season, am I? I met with this client in October of the previous year, in October. Now, that isn't very much time towards the end of the year, but you can see what the power of planning is. The power of planning ahead, setting in motion a plan, a strategy to pay your obligation in tax and not a penny more than your obligated amount is going to be worth its weight in gold. And you know how long our conversation was in that appointment? An hour-long conversation to drop their liability from $170,000+ down to below $40,000. He's been a client of mine for a very long time, and if I could share with you where he's at now, he owns multiple commercial buildings in Southern California. He has over $1 million in Tesla stock in his 401k now, which he never had a 401k before he came to meet with Robert Hall. I mean, the guy, I call him a kid, the guy is sitting on quite a significant platform of wealth now, and it's all because he switched up his game plan. It's all because he put a plan in place and implemented that plan to perfection based on the advice of a licensed tax advisor. That real estate professional election out of that significant tax decrease was about a $30,000 to $40,000 sway in liability, if I can remember correctly. This was a while ago, but I use this example a lot because it's the quintessential example to show you how important tax planning can be and is. And so out of that real estate professional election, just by clicking that box and qualifying him for, checking off all the boxes and the requirements that need to be met, it ended up dropping his liability another $25,000 to $30,000. So very, very important elections for you to make if you qualify. Not everyone will qualify. It's not the Wild West. You just don't want to pop up a software program and start clicking boxes and wait till your liability drops below a comfortable amount. That's not how tax preparation works. You need to work with somebody who knows the game. It is a chess game day in and day out with the IRS. I used to play chess with my grandfather, and when I was young, I didn't understand why chess was so unique, was so important. I just enjoyed time with my grandfather. But now as I grow older as a tax professional, as a real estate investor, I realize that everything in life is a chess game. And with the IRS especially, you need to be one move ahead, but you need to play on the same playing field that they play on, within those four walls, hypothetical walls of the Internal Revenue Code. So before you start doing it, making any of those elections, make sure that you talk with licensed tax advisors. Robert Hall & Associates, our family, wants to wish you a very, very happy new year. 2021 is off to a very interesting but amazing start. We are going to make 2021 one of the best years possible. 2020 got people down a little bit. I have some very, very high hopes for 2021. I have high hopes for all of you who are attending. Thank you so much for logging in today and learning about a topic that isn't exactly the most exciting thing to learn about. I do want to let you know before we hop into Q&A that we do service clients in all 50 states. We have one location here in Southern California, family run since 1971. We are celebrating our 50-year anniversary this year, and we celebrate our victories in all 50 states. A majority of our clients, California clients, but we do actually file tax returns in all 50 states. So just be aware that if you have investments elsewhere, you don't have to use an accountant in that state. You could very much use an enrolled agent who is licensed by the federal government to prepare taxes across all 50 states. We offer a number of services, just once again to kind of fly through this, from tax preparation to internal auditing, bookkeeping services, payroll services, accounting, financial planning. And at the very bottom of the right-hand corner, we do incorporate businesses. We start LLCs, S-Corps, C-Corps. We teach people about the benefits of incorporating. So keep that in mind. You are not alone. We are here and readily available to assist with all of your financial and incorporating and tax services needs. So let me make sure we go on to the next one here. Oh gosh, for some reason this clicker. Oh yeah. So through this tax consultation that we offer reviews of 2 years of tax returns. We could check for possible audit triggers on returns that have already been filed. And if we need to correct those triggers, we'll go ahead and amend prior year tax returns. Most importantly, we'll put you on a tax email update to let you know about significant changes coming up in 2021. If anything, you should sign up for our consultation to get those email updates. In 2018's tax reform bill was the most significant reform to the Internal Revenue Code dating back to the mid-'80s. Okay, we have another reform coming up under the Biden administration that might also correct most of what was corrected in 2018. So it keeps me gainfully employed. So I'm staying very hopeful about all of this. But in my gainful employment, I also have an obligation to reach out as Robert Hall & Associates. We have an obligation to teach people not everything that we know, but how to utilize what we know to pay less overall income tax the correct way. Okay, so sign up for this free consultation. Right now, if you're looking at your screen, there's a little QR code that pops up. And all you have to do, if you have a smartphone, you open up your camera, you move your camera over the little QR code on the left side of the screen. It'll automatically prompt you to open up a link. And that is how you submit for the free 30-minute consultation. At the moment, because of the pandemic where we're at in today's world, we are doing most things by phone, by FaceTime, by Skype. I can't wait till we open back up so we can see your lovely faces in person. We very much look forward to that. And with that, Jeff, I think we're ready for Q&A.
Great. Thank you so much, Tony. This is awesome. Good stuff. I told you it would be good, didn't I? Now, so there's the free consult. Was there anything else for the AOA members?
That's right. Thank you so much for reminding me, Jeff. So for AOA members, we have two offers, not only the free consultation, but also $50 off of your initial year tax preparation fee. So if this is your first year with Robert Hall & Associates, you get a $50 discount on the preparation fee. Right. And we are actually going to be working more closely with AOA. We've been working with AOA for a very long time to bring more added service to AOA for all of their clients' members. So make sure that you join AOA. That membership offers you a number it opens up a plethora of referral sources that are incredibly valuable. Not only Robert Hall & Associates, but other referral sources that money can't buy that kind of advice, to be real honest with you. And so I know that a majority of the referrals that we've talked to that are AOA referrals, they also sometimes offer free consultations. So make sure that you join AOA. It is absolutely worth every single penny that you invest into that membership.
Well, thanks for the kind words for sure. And yeah, it's for $79, you get a whole bunch. And we have a bunch of questions here, so let's get to them, right? We have Lego and origami. And everybody, you get one question. We start with one, and then after that, we'll go through everybody, and then we'll come back around for it. So let's see what we can do. Lego and origami. Your first question he answered, so I'm going to go for your second one. I use my home as an administrative office to handle paperwork, but I do not meet the home office deduction criteria exclusively. Can I still deduct some expenses such as internet and utilities?
So I'm going to assume, I don't like assuming things, but I'm going to assume that you are currently an employee, a W-2 wage earner. So if you use an in-home office as a W-2 wage earner, unfortunately on the federal tax return as it stands for 2020, there is no write-off for your in-home office. Now, California will still allow for a nice adjustment for this, so I'm not telling you not to deduct it. I'm just saying that on the federal side, you're not going to get a benefit for it. That 8829 form for the in-home office for an employee it's no longer available as a write-off. California has not conformed to that part of the Internal Revenue Code, so still put that write-off on your return, which will allow you to deduct or allocate a percent of your mortgage interest, your property taxes, your utilities, maybe even your HOA dues, other improvements to your in-home office space to offset your W-2 income, but only on the state side. On the federal side, if you are self-employed or you have a self-employed type form with some non-passive income attached to it, yes, you will be allowed a portion of your home as a write-off. So it really all comes down to the difference between whether you are a W-2 wage employee versus if you have self-employed or some sort of non-passive income that we can play around with.
Great. Okay, we have Mr. Cruz. And this question, is it better to pay a property manager a salary or give them free rent?
Well, you can actually do both. However, when you give a property manager free rent, the federal government has a very unique part of the Internal Revenue Code that states that if services are being exchanged for free rent, in this case, the property manager is working and therefore you're giving them free rent, there is still a taxable transaction involved in that. And so the proper way to really do it, to be real honest with you, is to put them on payroll and to deduct their payroll. However, I'm not telling you that that's right for you. This is a very specific scenario. And so if you are getting a much higher valued service for what you're discounting in rent, it actually may be worth it for you to do the latter, not put them on payroll. But at the end of the day, most of our clients, if they actually have a property manager, they do formally put them on payroll, and most property managers would opt to be put on payroll rather than having free rent, because at that point, especially entering into the pandemic last year, they would have liked to have the ability to claim unemployment insurance as well as potentially state disability insurance. And if you are exchanging rent for services provided, they are not paying anything into state disability or unemployment insurance. So coming out of this pandemic, I think that people have a different approach to how they would like to be paid. Some individuals, because they did not pay themselves out of their business, they did not qualify for some of the pandemic relief benefits. And so, even though you saved tax in the past years, it kind of ended up leading you down a road that wasn't beneficial because of the pandemic occurring. So once again, I think that it's best to sit down and analyze that on a one-on-one basis, but I think that what you're probably safer off doing is actually putting that property manager on payroll.
Great, thank you. And here's one from Dan. Do you recommend putting investment property in the trust?
So trusts are very unique. Remember that trusts, there are different types of trusts, first off. There are land trusts, there are irrevocable trusts, there are revocable trusts, there are family living trusts, there are charitable remainder trusts. So depending on what type of trust you're using, the most common is a family trust or a living trust. The trust is not going to protect you from, in most cases, potential litigation, in most cases not from debt collectors, in most cases not from anything except for probate in the state that you own the asset. So the correct tiered structure, if you are a family person, if you have next of kin, if you have a need to protect your assets, is to have the insurance policy on the property owned by an LLC, and the owner of the LLC is your living trust. And that is the I called it the golden pyramid, because you are protected at every angle. The walls are solid in that tiered structure. And so once again, a trust is really to protect you from potential probate implications, not necessarily from potential litigation or any sort of insurance claim. So you would absolutely want to exercise all three of those options.
Great. And here's one from Mr. Ho. I did a major remodeling of a rental unit in 2020. Can I deduct all the kitchen cabinet, kitchen appliances, new wood floor in 1 year instead of amortizing them over the useful life?
So there are different changes under the CARES Act for qualified improvement property, which mainly covers most improvements in the interior part of a property. Once again, this is a very specific deduction that you're looking for, so I would need to dive a little bit further into detail with you one-on-one as to what those expenses are. The cabinets, the fixtures, the appliances, a majority of that will qualify for accelerated depreciation. Whether or not you're allowed to dollar for dollar deduct it is a very specific scenario that we would need to go over. If for some reason something wasn't able to be accelerated as a write-off, you have an option of doing something called a cost segregation analysis. Perfect example, I do have a client who just finished one of their cost seg analysis with a third-party vendor, and I'm sure that AOA has some great referrals for cost seg. This is an election that is made with the government to reach into future years and take remaining depreciation all in 1 year. So let's say, heaven forbid, forbid, we get through the analysis on your return, we're able to accelerate, let's say 60% of your qualified improvement property, QIP, and there's 40% left over. Well, we're not up a creek without a paddle just yet. We can actually exercise our right for a cost-seg analysis to figure out what the remaining amount of that depreciation expense is to accelerate it and take it all in 1 year. But at that point, we need to make sure it makes financial sense. We have to talk with a cost-seg specialist to see what the cost of the cost-seg analysis is and to figure out how much tax reduction you will receive by reaching forward into future years and capturing future depreciation currently. One other conversation we would need to have at that point, whether you're not doing cost seg or just accelerating regular QIP property, qualified improvement property, is when you are when are you deciding to, or what are you deciding to do with this property? Do you want to sell it 3, 4, 5 years down the line? Are you planning on exchanging it? Are you planning on leaving it for your heirs? If you're planning on leaving it for your heirs and holding it for the rest of your life, absolutely. Let's go ahead and accelerate depreciation, save the money now so that we can buy more property. If you're just taking the accelerated depreciation under the CARES Act down from 27.5 years down to 15 years, okay, that's great if you're going to hold on to that property or exchange the property down the line. But if I ask you this question and you tell me that, well, I was thinking about selling the property 2 or 3 years down the line, we might want to void accelerated depreciation altogether, because 2 years down the line, guess what? When you sell that property outright, if you do not exchange the property, if you don't hold it for your heirs in death, all of a sudden when you sell that property, all of that depreciation write-off you took, you have to recapture, add back onto your return as income, and pay tax on it. I'm not saying that scenario you shouldn't take depreciation. I'm just saying that will involve some significant tax planning revolving around that particular conversation. I am very much a person who believes 1 in the hand is worth 2 in the bush. Yeah. I want the money now so that I can invest and control the dollar now. So for me, I'm taking as much depreciation immediately as possible. I'm not looking 2, 3 years down the line, and if I have to recapture depreciation, I'll find another tax shelter to plug into that game so that I can reduce that liability in that future year. So once again, personally, I think that take depreciation when you need, when it saves you money. Professionally, I have to look at all of the options. So just keep that in mind.
Yeah, $1 today is definitely worth more than $1 tomorrow, right?
Mm-hmm. Absolutely.
And for more on cost segregation, that's interesting. Actually, last week we had a specialist come in, and he shared, and he'll definitely make it worth your time. And he had another great offering for the AOA members. So check that one out. It's it's on cost segregation, and if you're on the AOA USA channel, if you on YouTube, if you search that, and there'll be a whole list of videos that come up there, and so you can just click it. It's literally just last week, and you'll be able to find it real easily. Anyway, so that's on that one. Here we go. The next question: what is the best way to hold a 4-unit in California for legal protection? The LLC has the $800 minimum state licensing expense and a separate tax return cost.
So this is going to be a two-part answer. Just to let you know, first and foremost, I'm not an attorney, so this question, I assume that you're looking more for a legal answer, which I can't really give you, unfortunately. I can tell you right now that the most common entity used for holding title is the LLC. And yes, on the California side, once again, California is the highest tax state in the U.S., which, no surprise that we have also the highest filing fee in the U.S., which is up to $800 minimum per year. And an LLC also potentially gets hit with something called gross receipts tax, meaning that if I own a shopping center that generates $600,000 in gross rents, I not only will have to pay the $800 filing fee, but I will get hit with a gross receipts tax above and beyond that, which can be upwards of $6,000 depending on the gross revenue. In fact, it could be upwards of $12,000 if your revenue is well above $1 million threshold. I'd have to look up that specific threshold. But at the end of the day, you are not incorporating as an LLC for any tax benefit, are you? LLCs do not save you any tax. LLCs only provide limited liability protection. So there is very much a right and a wrong time to incorporate, and you should only ever be starting LLCs, S Corps, and C Corps per the advice of 2 professionals, an attorney and a tax professional. Okay? Because an LLC is not going to save you tax. If you listen to an advisor and they say, hey, let's start an LLC because it's going to save you a lot of money, walk out the door. LLCs provide absolutely no tax benefit unless they elect to be taxed as an S corporation. Now that opens up a whole other conversation, and remember what I said about corporations. S corps and C corps should not own rental investments. So even though I said S corporations are the only entities that will save you tax, if you elect to be taxed, the LLC elect to be taxed as an S corp, yes, it will save you tax, but it will not save you the type of tax that you pay on rental property income. So LLCs are best for rental properties, for great limited liability protection, for self-employed businesses. S corporations, C corporations are options, but whether or not it is the right time for you to start one of these three entities is a different story. If you are looking for that added layer of asset protection, an LLC and that that nasty $800, what I call a parking ticket for parking your business here in the state of California, it is tax deductible. The $800 is a write-off. At the end of the day, even though it seems steep, it is very much a valuable thing to have an LLC for greater limited liability protection. So in my opinion, the $800 is worth every penny.
Great. All right. Here's one on YouTube from Jay Barry. For a duplex in which one unit is owner occupied and the other is rented, do you still generally recommend an LLC?
For a unit where one is rented, and you said owner occupied for one, rented out for the other, an LLC. So yes and no. If you live in the property as a primary residence, you want to make sure that the LLC really is only holding ownership to the business portion. And there's a way that you can write that into the LLC agreement, because what you do not want to give up on the primary residence side is the Section 121 exclusion. See, what's built into the current Internal Revenue Code is something called it's Section 121 of the IRC. And that states that if you sell a primary residence, if you've lived in it 2 out of the past 5 years, you can exclude up to, if you're single, up to $250,000 of taxable gain, so tax-free $250K. If you're married, you get double the exclusion. You get a $500,000 exclusion. If you put the full property in the LLC, as if the full property was the business, you could void the Section 121 exclusion. And so there is a creative way to get LLC protection on only the business portion of the property while still being allowed that Section 121 exclusion at the end of the life of the asset when you sell it on the primary residence side or portion of that investment.
All right, here's a question. Actually, yeah, I'll skip that one. Diana, if I own an income property in an LLC, do I need to worry about Prop 19?
If you own yes. So the only way to avoid Prop 19 at the moment, just once again being very general with this advice, because everyone's situation is different. The only way to avoid Prop 19 reassessment is if you live in the property that you are taking over. It has to be a primary residence. And remember that a primary residence, as soon as it's put in an LLC, it's seen as a business asset. Because an LLC is not meant to structure, or it's not a structure that's meant to protect personal assets. It's meant to protect business assets. So by putting a property in an LLC, you are not avoiding Prop 19 reassessment.
Great. And for more on Prop 19, last week there was a whole, we did cover that topic as well. It was a double header last week, so you can look at that video and you might get your question answered. I bet you do. And here's one, the next question. If the trend is for Californians to move out, will the California property values decline? What's your take?
California property. What's my take on people leaving California? Is that,
well,
is that the
do you anticipate the price of property to go down because the demand's going to be less because people are moving out? Is the question.
That is a question that probably would be best asked of another type of professional. I mean, income tax wise, I'll tell you this. I'll tell you I'm going to give you my professional opinion, my personal opinion. My professional opinion is that California real estate is the mecca of real estate. It probably will always continue to be the mecca because we sometimes forget that people around the globe, okay, not just here in the U.S., but people around the globe dream of living on the Golden Coast. They dream of the California lifestyle. There are songs written about the California lifestyle. So business is second to none here. Business, real estate is second to none here. Are we going through some transition phases? Yes, absolutely we are. We've been through transition phases before. We will weather the storm. Real estate here is incredibly valuable. It will continue to be incredibly valuable, even with the 1%ers jumping ship. There will still continue to be a need for real estate here in the Southern California area, all across the state of California. And I think that we will go through an ebb and flow, so to speak. I don't think that we are going to see a forever downturn in the state of California. And let's face it, once again, I always veer back to simple economics, supply and demand, right? We have a certain amount of supply, but we have very high demand, right? And that has always been a pretty common scenario for California. If you're asking, that's my professional opinion, is that California will always continue to be a valuable state to invest in. My personal opinion, I think that if I had the option of buying $2 million property in the San Fernando Valley versus buying $2 million in real estate and having 20 doors elsewhere in the US, personally, I'd rather have 20 doors. I want cash flow. I want to know that if I have 2 vacancies, I have 18 people who are still paying me. I want to know that no matter what, that valued property will always be a need for people, whether the economy is good or bad. We know that about real estate. Whether the economy is good or bad, people will always need a place to live. And if I can own 20 doors versus 1 door, I'll take 20 over 1 any day of the week.
Right. Great. And also another thing to consider is just the value of the dollar. And if you anticipate the value of the dollar going up or down, that also might be a really good consideration. I think we all can see that there has been a lot of spending, government spending and printing money, and there's more of it to come in the near future. So you would imagine that there would be a lot of inflation. If you're holding property, the property value will just go up with the inflation. Mm-hmm. That's another thing that you could consider probably. Mm-hmm. And next question. Okay, if you create an LLC in another state where the property is located, how does it affect your taxes in California?
Oh, like I mentioned earlier, California is a very unique state. California is one state that taxes us on our worldwide income. So if you set up an LLC elsewhere to hold a property in that state under the LLC, but you individually register to vote here in California, you drive around a car with a California license plate, you have a California address on your driver's license, by definition, you are a California resident. Therefore, you got to play by California's rules. So you file a foreign jurisdiction LLC filing fee of $800 to the state of California. I have heard and listened to many professionals talk about how to avoid California's filing fee. I'm not going to argue with anybody. There may be some creative ways using land trusts to do that. I have yet to see case study on it. And at the end of the day, as much of a professional as some people are, I have to be very wary of the advice, especially in today's world. I'm not calling people liars. I'm not telling you that they're wrong. I'm just saying, show me case study that you can avoid paying the California filing fee, an actual case study, something that passed through the Franchise Tax Board Court of Law, and that was argued in the state of California, that shows that you can live here in California full-time, have LLCs elsewhere in the U.S., and you individually are not having to pay that $800 filing fee. And then I will use that case study from time and time again to avoid paying the California filing fee, but I've yet to see that case study. I have seen C corporations file elsewhere in the U.S. and avoid California filing fees. But when you're talking about real estate-related investments under LLCs, there are very few situations where somebody could truly avoid paying that filing fee on an annual basis. And we can run through a lot of those scenarios with you if you have questions about certain scenarios. One of our tax professionals at the office would be more than happy to walk through as many scenarios as possible with you.
Great. And here's one from Gilda. Can I offset a real estate gain against a long-term capital loss carryover from stocks?
So the great thing about stock loss, or not, there's nothing good about any losses, but finding the silver lining in all of this, the great thing about long-term loss in real estate and long-term loss in real estate is that they're both capital gain and capital loss figures, meaning that if I lost, let's say, $300,000 in long-term capital loss through a stock investment, and I sold a property, a rental property, and I had a $300,000 long-term capital gain, I can offset the capital gain dollar for dollar with my banked up loss. However, what that capital loss doesn't offset is your recaptured depreciation. So just because you have $300,000 in losses, $300,000 in capital gain, and that's not paying any tax, doesn't mean you're out of the woods or in the clear. Because when you sell a rental investment, unlike stock gain sales, when you sell a rental property, you have not only capital gain on both the federal and the state side, you also have recaptured depreciation tax. So even though you might not be paying any capital gain tax, you will still be paying income tax on the recaptured depreciation. Now, on the opposite side of the spectrum, let's say you sold the property for a loss and you sold stock for a gain. That is a very unique situation, because when you sell a rental property at a loss, it falls under Section 1231 property, also known as 4797 business property. And not only is the loss on the property tax deductible dollar for dollar against potential capital gain, but it also offsets ordinary income because it is a business loss at that point. This probably is a whole hour to 2 hour webinar just in itself, but I want to let you know that the loss on real estate, there are much greater exit strategies for losing in real estate than there are exit strategies for losing in the stock market. I guess that's the easiest way that I could put it. Real estate, we love it because it has great upsides, and even on the downside, there are some still very, very, very beneficial ways to exit out of those real estate investments from a tax perspective.
Great. Here's one from Patsy. For a real estate professional qualification, is the 750 hours she's just asking, is that a total for the year, or she's just wondering how you calculate those hours. Can it be divided over other properties?
So 750 for a real estate professional, non-rental property related, 750 hours is for the practice itself. If you have properties, technically the 750 hours is per property, and that is active management. So I run into this issue a lot with people who say that they are actively participating. So when I hear them on the phone, I say, "Oh yeah, well it sounds like you do actively participate." And then I take a look at their tax return, and they have a $7,000 property management fee being deducted on their return. And I say, "Well, I thought you were actively participating in." And they say, "Well, yes, I manage my managers." Well, unfortunately, the government in most cases does not allow that as an argument for active participation. I have a very specific example that actually did win under audit, where the individual hired somebody solely to collect rents. That's it. They didn't repair the property. They didn't fix the property. They didn't go out there when it was raining and put sandbags down so that the driveway didn't flood. They didn't do any of that. The property management company didn't do any of that. They were only hired to collect rent. In that case, even though they had property management fees, we still made the active participation election. So once again, case-by-case scenario states that some individuals will qualify for that active participation. And in most cases, I'll be real honest with you, I don't really follow the 750 hours as much as I follow the 51 rule, because the 51% or more of your time and 51% or more of your income generated in real estate related income and spent in real estate related activities weighs much heavier under audit than the 750 hour rule. At the end of the day, could an agent ask you for an hour log? Yes, they can. And we've seen that a couple times, not with any audits that I represented, but our office. In the past, we have seen agents ask for hour logs. And at that point, we have a template that our clients can have that allows you to map out the hours that you've put in to any one of your real estate related investments. But once again, it all comes down to what is questioned under audit. And under an audit, they're really looking at individuals who are, I'll give you an example. Let's say you're an emergency medicine doctor making $1 million W-2, but you decide that because you only work 3 months out of the year fixing people's brains, and the rest of the year you spend working in real estate, that they're actually more of a real estate professional than a medical professional. Unfortunately, that doesn't work. The 51 rule clearly states that 51% or more of his or her revenue is generated through medical professional services, not through real estate related services. So once again, case by case scenario, and at that point it all comes down to proper representation under audit.
Great. And do you want to answer questions about Prop 19, or should we just,
I can. I just don't want anybody to be disappointed with the answers.
Or should we just have them watch the one that's on Prop 19 from last week? What do you think?
Sure.
Which either way you want to go is fine.
I think that it probably would be best for you to watch the Prop 19 conversation. I don't want to overpromise and underdeliver with my answers.
Great. Okay.
But, yeah.
And here we are. What is the income threshold to pay zero on the capital gain of the sale of a rental primary residence?
So your technically you have to be under the 10% bracket. As far as the threshold, it's changing for 2021, and it's different for married filing joint, married filing separately, head of household, and single. But I know the bracket. If you're under the 10% bracket, federal capital gain will be zero. And technically, we've seen a couple scenarios where people who are solely on Social Security income, they've been able to sell rental investment property with low depreciation recapture. Remember, because your capital gain is only one part of the equation. Just because you're selling the property and making, let's say, $100,000 in capital gain, and your other income is under the 10% bracket, you can't just assume that you're not going to pay income tax. You might not pay income tax on the $100,000 capital gain, but if there's recaptured depreciation of $30,000, $40,000, $50,000 on the sale of the property, let's say, that will put you above the threshold to where you actually do have to pay capital gain on the $100,000. So it's not so much about the threshold. It's about the different types of revenue streams or earned revenue that you have reported on your tax return. 9 out of 10 times I can tell you that if Social Security is your only income, you don't have any W-2, you don't have unemployment, you don't have capital gain, you don't have interest or dividends. If you only have Social Security and that's your only source of income, 9 out of 10 times your capital gain rate will be 0.
Great. Thanks for that. All right. Here's a good one. I did an exchange with my sister in 2019. He bought her share. When can I sell that new property?
You said 2009?
2019.
2019.
Yeah.
So in order for the question is, when can you exchange that property?
Yeah.
Most exchange accommodators will state that you have to hold the property as rental investment for at least 2 years and a day before it qualifies for an exchange. On the back end, once you close on the exchange, I believe that you have to hold it, and don't quote me on this, but a year and a day. I would actually have our exchange accommodators answer these questions in most cases. I believe it's a year a day on the back end that you have to hold it before you actually end up selling the property again. But at the front end, it's 2 years and a day.
Okay, here's one from David. What about an S Corp as a realtor?
Oh, a beautiful, beautiful question. Absolutely, in like 98% of the scenarios, but it doesn't really focus in on the profession that you're in. It focuses on the net profit. So the net profit through your realtor business is really the determining factor of whether or not an S Corp is right for you. You should be averaging, and this is just a personal and professional opinion of mine. This is not something you're going to Google and find an answer on. It's my professional and personal opinion that you need to be consistently netting a profit as a realtor of at or around $40,000 to $45,000 per year in order for the S corporation to be warranted, in order for the S corporation actually to save you more than it's going to cost you. If your profit, after all of your expenses are taken into account, if your profit is $15,000, $20,000, the S corporation structure and the payroll that's required to go through S corporation structures, it would actually end up costing you more to be incorporated than what it's actually saving you in tax. So your net profit has to consistently land at or around or above $40,000 to $45,000 for it to make sense financially.
Great. Here's one from Derek. What are your thoughts on a California rental property being held in an irrevocable trust owned by a California LLC?
An irrevocable trust owned by an LLC? Well, I think that's backwards. I think it would be the LLC owned by the irrevocable trust.
Right. Yeah,
you know, once again, and these are, remember, trusts are legal entities. There really is no tax benefit to a trust. It is really just to protect you from probate, and in some cases, with a revocable or an irrevocable trust, it's to limit what options you and your heirs have with changing or altering the assets within that trust. I like that type of structure, but only if it's per the advice of an estate attorney. And so at that point, you'd have the property owned by the LLC, and the owner of the LLC would be your irrevocable trust in this case. But hopefully your irrevocable trust was set up per the advice of an estate attorney. A living trust normally 99% of the time is the go-to trust unless your assets are at a certain value, or if you have multiple heirs and you want to control the way that the assets are inherited after you pass away. So there are a couple other moving pieces to that particular equation, but I think it would be your property in the LLC and the LLC owned by your irrevocable trust. I actually really like that structure. Like I said, I mentioned it. It's kind of the golden pyramid, right? You have the insurance policy on the property under the LLC owned by a trust. That way you're protected from at every corner and from every angle.
Great. Here's Lucia. She's doing a 1031 exchange. I got the replacement property and rent it for 2 years. After those 2 years, am I going to recapture the depreciation of the old or sold property?
If you sell the property, so if you
Yeah.
exchange into a new property, hold it for 2 years. At the end of the 2 years, no, you do not pay any tax on it unless you sell the property outright. That's the beauty of a 1031 tax deferred exchange. You could take one property and exchange into 10 properties and own those 10 properties for the rest of your life, and nothing gets paid in capital gain tax or recapture depreciation tax. Now, if you exchange from one property into 10 properties and a couple years down the line you decide to sell 3 out of the 10 properties, yes, all 10 of those properties now have adjusted basis figures. And so when you sell those 3 properties, you're not going to pay the recapture depreciation and capital gain on the full 10 property portfolio. You're only going to pay 30% or on 30% because you're only selling 3 out of the 10 new properties. So no, in your question, that new property that you've exchanged into, you won't ever pay capital gain or depreciation recapture tax until you either sell the property, or no, and not either. It's until you actually end up selling that property outright. You can actually end up exchanging that property, shoot 3, 4, 5 more times if the exchange sticks around, and still continue to defer the tax. And maybe you defer the tax long enough to where your basis in your property actually becomes 0, where you have no more depreciation. And at that point, you're probably cash flowing like crazy. And so there are other options. There are other moves that you can make to further reduce now this high cash flowing property and keeping you in a lower income bracket, per the advice and strategies outlined by a tax advisor.
On YouTube, we have Raymond. Which is the best way to sell out my properties and pay the least amount of capital gain and recapture of depreciation taxes?
Well, isn't that the golden question? How do you pay no tax? I get that question all the time. Hey, I made all this money. I don't want to pay any tax, right? That's the overall goal. There are efficient and effective ways to minimize liability on the disposition side of properties. Really, the only way to avoid capital gain and depreciation recapture altogether in totality is either, number one, to lose as much on the property as you have recaptured depreciation, meaning that if the property is worth $1 million and you have $400,000 of depreciation recapture, sell the $1 million property for $600,000. You take a $400,000 business loss to offset the $400,000 of recaptured depreciation. But who the heck wants to lose $400,000 on an investment, right? So that is one way to avoid recapture depreciation and capital gain. Number two is to exchange the property and defer the tax on the capital gain and recapture depreciation. And then the only other way probably to minimize overall liability and capital gain is to make enough improvement to the property to where you are increasing your basis enough to show no capital gain. The depreciation recapture number at that point is not being offset though. So that's not really the most efficient way, is it? Why would I buy a $500,000 property, put $500,000 into it, have a basis of $1 million and only sell it for $1 million? That doesn't make sense. Why would you ever own a piece of real estate where you put all that sweat equity into it and didn't make any money, right? Has it happened? Sure, it happened before, but that's not the goal of real estate. So really the true and only way to avoid capital gain and depreciation recapture is to either lose completely on the property altogether to where you don't pay tax, or to do a 1031 tax deferred exchange.
Great. Here's one from Amy. Can we do a 1031 exchange with a property out of the United States? I don't.
So you can exchange foreign property for foreign property, and you can exchange U.S. property for U.S. property, but not U.S. property for foreign property or foreign property for U.S. property.
Great. Here's one from Byron. I have a primary residence in San Diego and I own a fourplex in LA. Is there any advantage in leaving one apartment unit vacant for a secondary home? It's cash flow positive with 3 units.
There is never going to be a time where I tell you to keep a property vacant. If you have enough money to have a second home and leave it vacant, okay, that's a different conversation. But if you are trying to build wealth in real estate, vacancy is your enemy. Vacancy is something that you do not want. You want someone in there paying your debt every single day that you have the option to do so. So no, there would not be a benefit to leaving that as a second home. The only time that I could ever see a different scenario playing out is if you were planning on selling a property and claiming it as your primary residence to qualify for the Section 121 exclusion, but that would physically have to be your primary residence in order to get that benefit. In this scenario with your place in LA, your place in San Diego, to leave a unit open as a second home, I don't see any benefit to that. You're just actually losing potential revenue at that point.
Here we go. I think we'll wrap up with this question from Anastasia. How much does it cost to do a 1031 exchange?
That's a good question. I don't personally do exchanges, so that would be more like we charge services for our tax preparation services. An exchange accommodator would have their own fees. I can tell you, on average, I've seen for $1 million property exchanges, the exchange fee ranging anywhere from maybe $2,000 up to $5,000, $6,000, $7,000 plus, depending on who you use and kind of the ins and outs of the actual exchange. The price ranges. It's not really a flat fee for an exchange fee. You should talk to an exchange accommodator about what the costs are for the exchange.
Great. And before we wrap up, do you have any last words that you'd like to share with us?
Just make sure that you are surrounding yourself with like-minded individuals. Block out the negativity. I'm going to go personal for a second here, not professional. Personally, there's a lot of negativity in the world, and I think that 2020 was rough for all of us. It was a scary year. We were forced to stay at home. We were forced to not see our loved ones. We were told by news media outlets that things weren't true in most cases, and it created a lot of fear. People, make no mistake, I work in an industry where I see a lot. You might be in real estate and you might have your investments and you might log on to webinars and whatnot. I deal with individual people's businesses. And I personally do roughly 1,200 tax returns every single year. Our firm prepares just shy of about 16,000 returns each year. We see a lot. And I can tell you that people are hurting. It doesn't matter how much money the government prints, doesn't matter how much EIDL money or PPP money they put out, people are hurting. You need to stay positive. You need to assist and support businesses where you see fit. I'm not telling you have to donate money. If you are philanthropic, donate money if you have money to donate. But keep your eyes moving forward. Do not look back. There will be a number of opportunities that you can plug your money into in the upcoming years. Don't listen to how the economy is reacting to things right now. The interest rates are super low. People are borrowing money, what I consider to be as close to free money as possible. I mean, I don't know where else you can borrow money, the kind of money that people are borrowing, the level of amounts of money that people are borrowing at 2.4, 2.5%. Some credit unions are refinancing vehicles at 1.99%. I mean, this is the time to consolidate. This is the time to strap down, keep your eyes moving forward, keep your eyes on the prize, and continue investing in things you know will return you profit. And we know whether the economy is good or bad, people will always need a place to live. I know that it's difficult in California, specifically in LA, where people who are not you are telling your tenants that they don't have to pay rent. And that is something I have a personal belief about that. I'm not going to share that with you today. But at the end of the day, people are hurting, and my heart goes out to them. But at the end of the day, there is a reason why you are where you are, and why you own the investments that you invest in. And once again, just be ready for the next round of opportunities, because if you miss it, I doubt there will be another opportunity like this in our lifetime. I hope that there's not an opportunity like this in our lifetime again, because a lot of people had to suffer for the upcoming opportunities that we're going to be seeing. So as you start to build your wealth and take advantage of these opportunities, guess who's going to come knocking at your door at the end of every year? Uncle Sam. You will need tax advisors that update themselves, that educate themselves in the new and old Internal Revenue Codes, who study case study, and who are on your team. Not there to tell you what you can't do, but what is possible. Okay? So my best advice to you is surround yourself with like-minded individuals. Build your team now so that in the future, you already have your team in place to help you build and retain wealth. Thanks again, everyone.
Great. Yeah. And just remember Robert Hall and Associates, 500 5-star reviews. And, that's pretty incredible. So you want to use them. They're there for you for taxes. AOA, we're here for you. We want to help keep you in the know on all the different things from taxes to how to evictions, everything that's going on that you need. We want to be a resource for you. So please join. And I want to also ask you to subscribe to the e-newsletter that we have, and that'll keep you in the know. And that's free, doesn't cost you a dime. And you can also subscribe to the YouTube channel here and hit that notification bell. Then you'll get notifications whenever we do post something. And anyway, thank you for your time, and we'll see you next week. with Zebra Construction talking about retrofits. Thank you.